Toolkit's built. Now we use it. 15 scenarios across 3 episodes. Each one a situation you will actually see broken down the same way every time. What you see on the tape, what's mechanically happening, how to react, what proves you wrong, and the trap that catches most traders. Here are the first 5. Episode 6, The Playbook, Part 1. Scenario 1, the pinned range day. You see the index travel 1/3%, reverse, travel back, every push dies. VIX drifting lower. The map shows big positive gamma above and below. What's happening? Dealers are long gamma between 2 walls, fading every move. The market's inside a compression chamber. Reaction. Range trade it or leave it alone. Buy the low of the zone, sell the high small targets. Do not chase breakouts. The machine is selling them. Invalidation. A close beyond the wall on rising volume with the vol market confirming. The trap. Breakout traders donate money all day, get chopped 6 times, quit trading breakouts right before the regime flips. Scenario 2. The gamma flip break. The market slides toward the known flip level, and as it crosses, the character changes mid-session. Dips stop bouncing. The tape goes one directional. Each new low comes faster. What's happening? The dealer book flipped from long to short gamma at a knowable price. The stabilizer became an accelerant, and Vanna joins as IV expands. Reaction. Immediately stop fading. Cut new entry size, trade with the direction, or stand aside. If you're short, trail it. These moves extend. Know the next big negative strike below. That's an acceleration zone, not support. Invalidation. Reclaiming the flip and holding above. The physics revert as fast as they broke. The trap. It's oversold. Oversold means nothing in negative gamma. The mechanical seller doesn't read RSI. And remember, negative gamma predicts size, not direction. A violent upside squeeze is equally live, which is exactly why you fade nothing. Scenario 3, capitulation structure at the lows. After days of decline, put-call ratio above 1.5, skew stretched to panic levels, IV far above realized, massive fresh put open interest, and then today, price makes a new low and closes off it. Selling exhausts. What's happening? Protection buying has saturated. Everyone who wanted insurance owns it. Dealers are maximally short puts and maximally short hedges. The market is loaded with buyback fuel. Any stabilization means IV falls, Vanna buying, and puts decay, charm buying. The bears' own positions are the rally fuel. Reaction. Stop initiating shorts. You'd be paying peak insurance prices after the easy move. For longs, don't call the exact low. Wait for the trigger. An up day that holds, or IV breaking lower while price holds flat. When the rally comes, it'll be violent, so early partial entries with defined risk beat waiting for comfort. Invalidation. IV still making new highs with each price low. Saturation hasn't hit. The cascade is live. The trap. Buying the first green flicker inside a still accelerating cascade. Capitulation structure first. A bounce without it is just a pause. Scenario 4. The Vanna Rally. Why are we up? Nothing happened. A feared event passes without disaster. Nothing bullish occurred. Yet the market grinds relentlessly higher for 1 to 3 sessions on unimpressive volume, and bears call it fake. What's happening? Pre-event IV was inflated and put protection heavy. The event's passage crushes IV, out of the money put deltas collapse. Dealers buy back short hedges, while charm accelerates the same direction. The rally is dealers unhedging. No new buyer required. Reaction expected in advance into any feared event with rich IV and heavy puts. The asymmetry favors up on no disaster. Don't hold puts through the event just in case. You own the exact asset about to be crushed. If long, give it the full 1 to 3 sessions the yuan hedging takes. Invalidation. The event actually delivers. Vanna reverses. Dealer selling amplifies the break. The trap. Shorting it. Because the news didn't justify this move. Correct. The news didn't. The flows did. The move doesn't need your approval. Scenario 5. Charm week. The drift into OPEX. The week before monthly expiration, after an earlier sell-off left huge out-of-the-money put open interest below. Now, low volume upward drift, overnight strength, every intraday dip recovered by the close. What's happening? Peak charm season. Those puts bleed delta daily. Dealers short them buyback hedge on a schedule set by the clock every day into expiry as long as the strikes hold. Reaction. Don't short the drift. You're fighting a mechanical daily bid with a known end date. Longs can lean on it with tight invalidation and mark expiry. Friday. The flow stops that day. Invalidation. Price breaking down through the big put strikes. Those puts re-energize, deltas expand, and the flow flips back to dealer selling. The trap. Extrapolating the drift past expiry. The Monday after, the flow that produced 2 weeks of gentle grind is simply gone. The people who finally trusted the rally on Thursday bought the top of the pin. 5 tapes, 5 mechanics, 5 traps. Notice the thread. In every single one, the crowd reads price action and gets trapped, while the positioning reader knows which flows are forced and when they expire. Next episode, scenarios 6 through 10. The post-OPEX range break, the 0 DTE whipsaw, the earnings crush, genuine smart money call buying, and what it means when a famous support wall gives way in an hour. See you there.